Welcome back. I'm Rahul Agarwal, founder of Aris Alpha. Here we cut through the financial noise and focus on strategies that truly build long-term wealth. Please note that these discussions are insights for education, not financial advice, unless you're a client of Aris Alpha.
Stocks may get all the attention, but bonds bring balance. They create stability within a portfolio by generating steady income and reducing volatility. Understanding bonds helps you protect your capital, manage risk, and build consistent long-term growth. Part 1. Government versus corporate bonds. A bond is essentially a loan. You lend money to a government or a company in exchange for regular interest payments and the return of your principal when the bond matures. Government bonds are issued by national or local governments. In the United States, these include Treasury bills, notes, and bonds. They are among the safest investments because they are backed by the government's credit and ability to raise revenue. That safety, however, usually means lower interest rates. Corporate bonds are issued by private or public companies that raise capital for operations, expansion, or acquisitions. They offer higher yields to compensate for higher risk. The reliability of a corporate bond depends on the company's financial strength. Bonds from well-established firms such as Microsoft or Johnson & Johnson are relatively stable, while lower-rated or junk bonds carry more risk but potentially higher returns. Choosing between government and corporate bonds depends on your goals, time frame, and risk comfort. Part 2. Bond funds and ETFs. Instead of buying individual bonds, investors often prefer bond funds or exchange-traded funds. An example is BND. These funds hold a diversified mix of bonds across issuers, industries, and maturities. They provide several benefits: diversification, liquidity, and professional management. For example, a U.S. Treasury bond ETF might include hundreds of government bonds, while a corporate bond ETF might hold debt from dozens of companies. This diversification reduces the impact of any single bond default or price drop. The trade-off is that bond funds and ETFs fluctuate in value because they do not have a fixed maturity date like individual bonds do. Choose one with a low expense ratio. Part 3. Interest rate risk and inflation impact. Bonds are sensitive to interest rates. When interest rates rise, existing bond prices generally fall. This happens because new bonds are issued with higher yields, making older, lower-yield bonds less attractive to investors. This is called interest rate risk, and it affects long-term bonds more than short-term ones. A 10-year bond will lose more value from a rate increase than a 2-year bond. Inflation also plays a major role. When inflation rises, the purchasing power of your fixed interest payments declines. That is why investors often use inflation-protected securities, such as Treasury inflation-protected securities, or TIPS, or keep part of their bond allocation in shorter maturities during inflationary periods. A smart bond strategy adjusts to both the rate environment and your financial timeline. Part 4. Building a balanced approach. Bonds serve different purposes depending on where you are in your financial journey. For younger investors, they provide balance and risk control alongside equities. For those nearing retirement, bonds become a source of predictable income and capital preservation. A balanced bond portfolio may include government bonds for safety, corporate bonds for yield, and inflation-protected bonds for purchasing power. Blending these through funds or ETFs creates stability without sacrificing flexibility. At Aris Alpha, we help investors design portfolios where fixed income is not an afterthought, but a deliberate tool for resilience and long-term security. To learn how to integrate bonds into a complete investment plan, visit arisalpha.com or schedule a call with our investment advisor to explore a strategy that fits your goals.
Thank you for watching. If this resonated with you, share it with someone who could benefit. Until next time, invest with clarity and confidence.